Something rare has already happened, and the market's reaction to it has been strangely muted. Not calm. Not stable. Muted. That's usually how the most important shifts begin. Quietly. Without headlines large enough to match their weight. In January, a line that had contained pressure for more than 3 decades finally gave way. Not slowly. Not gradually. It snapped. A long-standing pillar of Japan's financial system moved into territory it hadn't entered since the early 1990s, a period most investors today know only as a historical footnote. On paper, it looked harmless. A percentage change. A yield adjustment. The kind of move that normally gets filed under technical and ignored by anyone not sitting on a bond desk. But this move was different. Not because of how high it went, but because of what it invalidated. For years, markets treated Japan as a constant. A place where time moved differently. Where interest rates stayed pinned. Where volatility went to die. That assumption didn't just shape Japanese markets, it shaped global portfolios, balance sheets, and risk models far beyond Tokyo. It became embedded. Invisible. Untested. Until now. What followed wasn't the response you'd expect from a routine adjustment. There was no orderly repricing. No patient absorption. Instead, behavior normally reserved for moments of acute stress surfaced almost immediately. Quiet coordination turned into visible intervention. Stability mechanisms designed to remain in the background moved to the foreground. That alone should have been enough to trigger concern. When institutions created to smooth volatility suddenly act as if volatility itself is the threat, something deeper has shifted. At first glance, this looked contained. A domestic issue. A local correction after years of suppression. But markets like Japan's don't exist in isolation. They're deeply woven into global capital flows. Pressure doesn't stay where it starts. It migrates. It looks for the weakest point in the structure. And what made this moment unsettling wasn't the speed of the move, it was the lack of resistance to it. Levels that had held through recessions, crises, demographic decline, and decades of unconventional policy simply failed. Without drama. Without a fight. That tells you something important. The system was already under strain before the line broke. For now, the conversation remains narrow. Commentators focus on Japan. Analysts debate technical explanations. Most investors still treat this as a regional curiosity. That won't last. Structural shifts don't announce themselves all at once. They reveal themselves through second-order effects, through stress that appears somewhere else, in places that weren't supposed to matter yet. And those effects have already begun to surface. Because what looks contained at the source rarely stays that way once capital starts to move. Markets have a language of their own. Not the language of press releases or policy statements. But the language of behavior. And when that behavior changes, it's usually because the assumptions underneath it no longer hold. In the days following the break, the response from global institutions carried a noticeably different tone. Not aggressive. Not panicked. But unmistakably urgent. Tools designed for rare moments were deployed with a speed and ease that suggested preparation, not improvisation. That's rarely reassuring. Under normal conditions, currency markets are meant to adjust on their own. Price signals move. Capital reallocates. Imbalances correct over time. Central banks observe from a distance. Intervention is supposed to be exceptional. Deliberate. Reluctant. This time, it was neither delayed nor subtle. When a major monetary authority steps into a foreign exchange market to stabilize conditions elsewhere, it isn't an act of generosity. It's an act of self-preservation. Contagion doesn't respect borders. And the fastest way to measure institutional concern isn't through statements, it's through where policymakers choose to intervene. What made this moment unsettling wasn't just the action itself. It was what the action implied. That left alone, the system might not have held. This wasn't about smoothing volatility. It was about preventing acceleration. Acceleration is what breaks systems. Not losses. Not drawdowns. Speed. When price moves begin feeding on themselves, when adjustments force further adjustments, control erodes quickly. Institutions understand this. That's why they act early, often before the broader market understands what they're trying to stop. Publicly, the narrative framed these moves as coordination, cooperation, routine dialogue between partners. But markets don't respond to words. They respond to flows. And the flows told a different story. Something had shifted in the background plumbing of the system. Pressure was building in places models assumed would remain stable. And once stability is questioned, it doesn't reassert itself easily. Still, the surface remained calm. Equity markets stayed composed. Credit spreads remained contained. Volatility indicators barely moved. That disconnect, between institutional urgency and market calm, is often where the most severe damage later originates. Because when stress is absorbed quietly, it doesn't disappear. It's transferred. Transferred onto balance sheets. Into leverage. Into instruments built on the assumption that yesterday's relationships still hold today. The longer that transfer continues unnoticed, the more violent the adjustment becomes when it finally surfaces. And it will surface. Financial systems are built on the assumption that pressure can be redistributed without consequence. That risk can be shifted, hedged, diversified, or deferred. For long stretches of time, that assumption appears valid. Until it isn't. What's unfolding now is not a shock. It's a release. For decades, Japan functioned as a sink for global pressure. A place where rates stayed suppressed, volatility stayed low, and capital could be parked cheaply. That role didn't happen by accident. It was engineered, reinforced, and defended through policy choices that prioritized stability above all else. But stability achieved through suppression carries a cost. Pressure accumulates beneath the surface. And when suppression ends, even partially, the adjustment is never gentle. As yields moved, the immediate effects were technical. Pricing models updated. Risk parameters adjusted. Margin requirements shifted slightly. All manageable. All familiar. But beneath that surface response, something more important was happening. Instruments built on the assumption of static conditions were being forced to reprice. Slowly at first. Then faster. Relationships that held for years began to loosen. Not break yet. Just stretch. This is how systemic shifts begin. Not with collapse, but with friction. Capital is not patient when returns compress and risks rise simultaneously. It looks for alternatives. It looks for exits. And when many actors reach the same conclusion at once, movement accelerates whether anyone intends it to or not. What makes this phase deceptive is how orderly it appears. There are no headlines about crisis. No emergency meetings broadcast to the public. Just quiet adjustments that feel incremental. But incremental change across a highly leveraged system is rarely incremental in its effects. The pressure that can no longer be absorbed where it once was doesn't vanish. It flows outward, seeking instruments, markets, and balance sheets that still assume yesterday's equilibrium. That's when secondary effects begin to matter more than the original event. For now, most of that pressure remains hidden in the mechanics of funding, hedging, and cross-border capital flows. It hasn't reached the places most investors watch daily. Not yet. But systems don't need everyone to react at once. They only need enough pressure to cross a threshold. And that threshold is closer than it appears. Because once the internal logic of the system changes, behavior follows, not because people panic, but because they no longer have a choice. Pressure doesn't disappear when a boundary fails. It relocates. For decades, Japan absorbed a specific kind of financial pressure for the rest of the world. Low rates. Stable funding. Predictable behavior in long-dated government bonds. That stability wasn't just domestic policy, it became an input into global risk-taking. A quiet assumption beneath strategies that depended on cheap, reliable funding staying cheap and reliable. When that assumption weakened, pressure didn't explode at the source. It moved outward. At first, the movement was subtle. Funding costs shifted slightly. Currency relationships tightened. Hedging behavior changed at the margins. Nothing dramatic. Nothing that would trigger alarms for most investors watching equity indices or headline inflation prints. But those early adjustments mattered. Because many large financial structures are built on spreads, not absolutes. They rely on small differences staying small. When those differences compress or reverse, the math stops working even if prices haven't moved very far yet. What began inside Japan's bond market started appearing in places that depend on it indirectly, in cross-border funding relationships, in currency hedges, in balance sheets that assume long-term rates in one country won't suddenly compete with long-term rates in another. This is where stress becomes dangerous. Not when prices fall, but when incentives change. When capital no longer gets paid to stay where it is, it begins to move. Not emotionally. Mechanically. Institutions don't wait for confirmation. They respond to altered constraints. They reduce exposure. They shorten duration. They raise liquidity. That process is not visible in a single market. It unfolds across many at once. The critical detail is this: when funding assumptions shift, selling is rarely isolated to the asset that triggered the change. It spreads to whatever can be sold quickly, efficiently, and in size. This is how pressure escapes containment. It leaves the place it was designed to stay and starts testing everything connected to it. And at this stage, most of that pressure is still moving quietly, inside plumbing most people never see. That won't last. Because once the internal logic of funding changes, behavior follows everywhere else. Markets like to tell stories about belief, confidence, optimism, risk appetite. But during periods of systemic stress, belief stops mattering. Liquidity takes over. Liquidity is not about what investors want to own. It's about what they are able to hold when constraints tighten. And when pressure builds inside leveraged systems, the priority shifts quickly from return to survival. That shift has already begun. As funding costs adjust and hedges become more expensive, positions that once looked conservative start behaving differently. Assets held for yield begin to compete with assets held for safety. Capital that once moved freely becomes selective. In those conditions, the first thing institutions do is simplify. They reduce complexity. They cut exposure that requires constant funding. They exit positions that depend on stable correlations holding indefinitely. This is where selling becomes indiscriminate. Not because fundamentals collapse, but because balance sheets demand relief. When margin requirements change, when currency hedges move against expectations, when internal risk limits are hit, assets get sold regardless of long-term conviction. Stocks, bonds, commodities, digital assets. Anything liquid enough to convert into cash quickly becomes a candidate. That dynamic doesn't show up as panic at first. It shows up as pressure. Prices sag without news. Rallies fail early. Volatility rises in unexpected places. For individual investors, this phase is confusing. Nothing appears wrong yet. Companies are still profitable. Economic data hasn't collapsed. Central banks are still speaking calmly. But beneath the surface, portfolios are being rebalanced not by choice, but by necessity. Liquidity is being pulled toward the center of the system. And when that happens, assets that benefited most from years of cheap, stable funding are the first to feel it, not because they are broken, but because they are exposed. Diversification is built on a promise that when one part of a portfolio struggles, another will hold. That different assets respond differently to stress. That balance, over time, smooths outcomes. That promise depends on one thing above all else: stable relationships. When those relationships change, diversification doesn't fail loudly. It fails silently. What's unfolding now is not a typical risk-off event. It's a shift in how assets relate to one another when the system itself is under strain. In environments like this, the distinction between risky and safe begins to blur. Stocks don't fall because earnings disappear. Bonds don't fall because governments default. They fall because the structure connecting them is under pressure. When large institutions are forced to raise liquidity, they don't sell based on theory. They sell based on availability. Assets that were meant to offset each other start moving together, not because their fundamentals align, but because they share the same funding source. This is how correlations change. Not gradually. Not politely. But when constraints tighten enough that behavior overrides models. For portfolios built on the assumption that bonds will always cushion equity volatility, this environment is especially dangerous. When long-term rates rise under funding stress, bond prices fall at the same time equities weaken. The hedge doesn't hedge. It amplifies. That isn't a failure of diversification in principle. It's a failure of assumptions. And assumptions are what systems rely on most when pressure is low. The unsettling part is that this breakdown doesn't require a recession, a crisis headline, or a policy mistake. It only requires enough pressure in the right place to force behavior to change everywhere else. That's why this phase is so difficult to recognize in real time. Nothing dramatic has happened yet. But the relationships that once absorbed stress are no longer doing so. And once that process starts, it rarely reverses on its own. Because systems under constraint don't heal through reassurance. They adjust through force. At some point, abstraction stops being useful. The system doesn't break because people misunderstand it. It breaks because the mechanism underneath it changes, and behavior follows whether anyone wants it to or not. The mechanism that has quietly governed global finance for decades is now reversing. For years, capital flowed outward from Japan in search of yield. Not because Japan lacked savings, but because its domestic financial environment made holding long-term government debt unattractive. Rates were suppressed. Volatility was managed. Returns were capped by design. That created a powerful incentive to move money elsewhere. The flow wasn't speculative. It was structural. Japanese institutions borrowed cheaply in their own currency, converted that funding into foreign assets, and earned a spread that looked modest in isolation but enormous at scale. That spread existed because Japanese long-term yields were held artificially low while yields elsewhere were allowed to rise. That arrangement became one of the quiet foundations of global liquidity. But foundations matter only as long as they hold. When Japanese long-term yields began rising meaningfully, that spread compressed. Then it disappeared. And once it disappeared, the logic that supported decades of outward capital flow stopped working. At that moment, behavior had to change. Capital that once earned more by leaving Japan could now earn comparable returns by staying home, without currency risk, without cross-border complexity, without leverage. The trade that once seemed obvious no longer made sense. That is not a matter of opinion. It is arithmetic. When arithmetic changes, money moves. What makes this shift dangerous is not the size of any single position, but the scale of the system built around it. The outward flow of capital wasn't just unlevered savings. It was magnified through borrowing, hedging, and reuse. Leverage sat on top of leverage. Balance sheets layered exposure on exposure. When the base yield changes, everything above it has to adjust. And adjustment, in a leveraged system, rarely happens smoothly. Positions unwind. Funding tightens. Assets are sold not because they are unwanted, but because they are available. This is the mechanism now unfolding. Quietly. Mechanically. Without discretion. And once it begins, it does not require panic to continue.